Lower interest rates sound like relief. Cheaper loans, easier mortgages, markets breathing again. So here's the uncomfortable truth. Governments are often nervous when rates fall too fast. Not because they hate growth, not because they enjoy pain, but because falling rates expose something fragile underneath the system, and once you see it, you can't unsee it. This matters right now because everyone is watching the same question. When do rates come down? Markets want it, voters want it. Debt-heavy economies need it. And yet policymakers hesitate. That hesitation isn't about inflation alone. It's about control. Here's how it works. Governments don't just set budgets. They roll debt, old bonds mature. New bonds replace them. And the interest rate determines how expensive that rollover becomes. Not just today, but for years. When rates are high, borrowing is painful but predictable. When rates fall slowly, governments can refinance carefully. But when rates fall fast, something else happens. Bond prices surge. Existing debt becomes more valuable, and investors rush to lock in yields before they disappear. That sounds positive. Until you look at the math. A sharp drop in rates signals that something broke. Recession risk, financial stress, policy panic. And once markets sense that, they stop asking what's the yield. They start asking who's exposed. Because falling rates don't just lower costs. They reshuffle power. Banks holding long-term bonds suddenly win. Pension funds look safer, for now. Highly leveraged players get breathing room, but governments lose something subtle. Urgency. High rates discipline spending. They force trade-offs. They slow promises. Low rates remove friction. Debt feels painless again. And that's where the trap lives. When rates fall too fast, governments are tempted to borrow aggressively, right before revenues weaken. Spending ramps up just as tax income slows. Deficits widen silently, and debt piles up faster than growth can justify. Here's the irony. Lower rates are supposed to stimulate the economy, but if they arrive too quickly, they often stimulate the wrong things. Asset prices jump first, financial markets rally, housing heats up. Meanwhile, productivity barely moves, wages lag, growth disappoints, the public sees easing, the balance sheet sees vulnerability. There's another reason governments hesitate: credibility. If rates drop rapidly, it tells markets the government and central bank are afraid. Afraid of recession, afraid of instability, afraid of what higher rates already broke. That fear gets priced in. Currencies weaken, foreign capital hesitates. Borrowing costs creep back up, despite lower policy rates, so the benefit erodes. This is why rate cuts are often slow, cautious, and frustrating. Not because policymakers are blind, but because they're cornered. They're trying to lower rates without signaling distress, to ease without inviting speculation, to help without admitting dependence. Zoom out. Decades of cheap money trained governments to operate with permanent deficits. Low rates weren't just a policy choice. They became the foundation. Now every rate cut tests how much the system relies on that foundation still holding. So when governments hesitate, it's not confusion. It's calculation. They're not asking whether lower rates feel good. They're asking what breaks if they arrive too fast. Because once rates fall quickly, going back up becomes politically impossible. Markets adapt, budgets expand. Expectations lock in, and the next crisis arrives with fewer tools left. So here's the unresolved question. If the system now depends on slow, controlled rate declines to stay stable, what happens when the next downturn demands speed? And will anyone be ready for the answer?